Welcome to the Opening Bell Report.
Today we are looking at a brand new, highly compelling financial analysis report that crossed our desks.
And it is a fascinating one.
It really is. It focuses on a deeply debated AI stock that has Wall Street completely divided right now. We are talking about a company called Rezolve AI that is trading under the ticker symbol RZLV.
Right. And it is a phenomenal case study in market psychology and financial mechanics, honestly.
For sure.
We have a situation here that presents this glaring paradox between the forward-looking technological promise on one side and the immediate, very harsh realities of the balance sheet on the other. That tension is exactly the kind of puzzle we love to take apart for you.
And the mystery at the center of this deep dive is what makes it so compelling. You have this AI company, Rezolve AI, and the data we're looking at highlights analysts literally slapping a strong buy rating on it.
Yeah.
They're throwing around price targets of $10 or more.
Yeah.
If you run the math on that whole, they are projecting a massive 300% upside.
Which is huge.
It is being touted as the $2 AI gem that could hit $10. And yet, and this is the crazy part, if you pull up the ticker right now, it is currently trading at just $2.73. Okay, let's unpack this.
We're going to do that by looking strictly at the fundamental analysis laid out in our source material.
Right. No hype, just the numbers.
Exactly. We are going to strip away the broader market noise and focus on the actual mechanics of the business. We will examine their hyper-growth metrics, and we will look at their highly competitive valuation. And crucially, we are going to shine a massive spotlight on a glaring red flag sitting right there on their balance sheet.
Oh yeah, we have to talk about that red flag.
Because that red flag is the key to understanding why the price is anchored at $2.73 today, despite those massive, aggressive projections.
But before we get into the heavy math and the gap revenue and the liquidity traps, we really need to understand what this company actually does to warrant this kind of attention.
Fair point.
The analysis report calls their business model the ends of scroll and click. And honestly, this resonated with me.
Oh, me too.
Think about your own everyday life for a second. Think about the last time you bought something online. I was trying to find a specific type of waterproof hiking boot last week.
Oh, I know how that goes.
Right. I literally had 40 tabs open.
Yep.
You go to a website, you type something into a search bar, you scroll through pages of grids, you filter by size, you filter by color, you click an item, you read the description, you hit the back button.
It is exhausting.
It is a completely static, exhausting process. It's essentially just a digital mail order catalog.
It is an entirely outdated model when you consider the computational capabilities we have at our disposal today.
Right.
Traditional e-commerce shifts all the labor onto the consumer. You are the one doing the searching and the filtering and the comparing, and this is where Rezolve AI solution comes into play.
Okay.
They are pioneering a space that is referred to as agentic commerce. They are doing this by utilizing proprietary large language models, or LLMs, to power a completely new type of commerce engine.
And to be clear, we aren't talking about a simple rule-based chatbot that pops up in the corner of your screen and asks if you need help finding the FAQ page.
No, not at all.
We're talking about enterprise-scale integration. Our research points out that Rezolve is building these conversational, highly intelligent AI shopping engines for massive global retailers.
Real massive scale.
We're talking about brands like H&M and Ferrero and Urban Outfitters. These are massive household names with immense daily traffic and wildly complex, constantly shifting global inventories.
That scale and complexity is precisely why this matters from a fundamental perspective. If you are a massive retailer like H&M, your digital storefront is your primary revenue driver.
Right.
What Rezolve AI is offering is the transformation of a static database into a proactive sales agent. But it goes deeper than just a conversation.
How so?
This AI isn't just chatting. It is actively tied into the massive real-time inventory management systems of these brands. It can query real-time inventory across hundreds of warehouses, check user purchase history, and apply dynamic pricing in milliseconds.
Wow. So instead of a customer guessing the perfect combination of keywords to find, say, a specific red summer dress in a size medium that is actually in stock, they can simply converse with the AI. They describe what they want, the occasion they are shopping for their style preferences, and the agentic AI curates the experience in real time.
Exactly. It completely changes the friction point of digital commerce. You are moving from a paradigm where the user executes the search to a paradigm where the user states their intent and the AI executes the labor.
That makes total sense.
It is akin to having the absolute most knowledgeable, proactive salesperson in the store, but they possess perfect memory of the entire global inventory and they are helping 3 million customers at the exact same second.
That is a massive technological moat if they can execute it flawlessly.
It really is.
So that is the product fueling the narrative. Now let's look at the bull case, the real financial hype that has Wall Street analysts throwing around these $10 price targets.
Shook it as the numbers.
Let's dig into the hyper-growth realities detailed in the report. In the first half of 2025, Rezolve AI reported a GAAP revenue of $6.3 million.
Oh. Yeah.
Now, wait a second. On a baseline of just $6.3 million, a massive percentage jump isn't that hard to achieve, right?
That is what people think, yes.
Isn't that just the law of small numbers? Is a 426% year-over-year increase really that impressive when you're starting from such a low base?
That is the exact skepticism the broader market is currently applying, and it is a classic trap. What's fascinating here is the severe disconnect between the trailing accounting data and the forward-looking operational metrics.
Okay, break that down for us.
You have to understand the difference between recognized GAAP revenue and contracted forward revenue. GAAP, generally accepted accounting principles, is strictly governed.
Right.
If Rezolve signs a massive $10 million enterprise contract today for a multi-year rollout, GAAP only allows them to recognize a tiny fraction of that revenue this quarter. It trickles onto the income statement slowly.
Which creates a massive lag. Algorithms and screeners scraping trailing GAAP revenue see a tiny $6.3 million company.
Yeah.
But the underlying reality is shifting much faster.
Precisely. The market is looking in the rearview mirror, but the analysis report points out that Rezolve exited 2025 with over $200 million in contracted ARR, or annual recurring revenue.
$200 million. That is a huge jump from $6.3 million.
It is. They didn't just meet their initial guidance of $100 million in ARR, they completely destroyed it. And these aren't just soft letters of intent. These are hard, contracted figures that simply haven't flowed through the GAAP recognition process yet.
Wow.
Furthermore, the management team is projecting an astronomical $500 million in ARR by the end of 2026.
And it's not just about the top-line revenue growth either. It is about the quality of that revenue. The data highlights an absolutely staggering 95.8% gross margin.
For anyone tracking the software industry, that is the metric that demands attention.
Why is that so crucial here?
In the software as a service business model, companies are heavily valued based on their gross margins because of the scalability. Once Rezolve builds the core LLM architecture and the proprietary commerce engine, the marginal cost to deploy it for the next enterprise customer is incredibly low.
Because the software is already built.
Exactly. A 95.8% gross margin represents top-tier elite profitability at the gross level. It means almost every new dollar of revenue flows directly down the income statement without being eaten up by the cost of delivering the product.
Here's where it gets really interesting. Let's lay out the valuation math based on these projections. Right now, Rezolve AI has a market cap of about $1.09 billion.
Right.
If they actually hit that target of $500 million in ARR, what does that do to their valuation multiples?
It creates a scenario where the stock is deeply undervalued relative to its peers. A $1.09 billion market capitalization divided by $500 million in forward sales means they are trading at a forward price-to-sales ratio of just 2.1x.
2.1x.
Yes. To provide the necessary industry context from the report, that multiple is remarkably suppressed. High-growth software peers in the current market environment, especially those with elite gross margins and triple-digit growth rates, usually trade anywhere between 8x to 12x forward sales.
So if we take a highly conservative approach, let's say the market is skeptical and refuses to give them a 10x multiple. Let's say they only get a 6x multiple.
Okay.
At $500 million in sales, a 6x multiple means Rezolve would achieve a valuation of over $3 billion.
Which is nearly triple where they are now.
Exactly. That mathematical expansion easily pushes the stock price well past that $10 mark. The foundation for the bullish argument is clearly there.
Assuming the growth projections hold true and assuming they can actually survive long enough to recognize that contracted revenue.
Right. Which leads us to the critical pivot. I know you, the listener, are looking at this and thinking, if the product is a revolutionary moat, and if the gross margins are sitting at 95%, and if the forward sales projections mathematically demand a massive re-rating, why on earth is this a $2.73 stock right now?
It is the million-dollar question.
Wall Street isn't stupid. They don't just leave a 300% upside sitting on the table for no reason.
They absolutely do not. And that brings us to the bear case, which is a very sober reality check regarding liquidity and operational burn.
Okay, let's look at the dark side.
The disconnect you just described comes down to one fundamental truth about hypergrowth tech companies. ARR is a beautiful metric for valuation, but it is not cash sitting in the bank today ready to be deployed.
It's a contractual promise to pay over time.
Exactly. And to scale as incredibly fast as Rezolve is scaling to go from handling a few million in JAP revenue to deploying complex, bespoke AI architectures for global enterprise clients like H&M, you have to incur massive upfront costs.
Right, you need servers and engineers.
Yes. You have heavy compute costs, massive data integration expenses, and huge sales cycles. The analysis report reveals that Rezolve is sitting on a painful operating income of negative $138 million.
Negative $138 million. That is a massive operational hole.
It is.
They are burning through capital at an astonishing rate to capture this market share. And this leads to what the data suggests is the most critical pressure point in the entire equation: the ticking clock.
The ticking clock, indeed.
Their operating cash flow is deeply negative, meaning cash is constantly flowing out the door to fund this hypergrowth. But when you look at their balance sheet, they only have $9.9 million in cash and cash equivalents on hand.
If we connect this to the bigger picture, the gravity of that number becomes the defining characteristic of the stock's current price. For a company with a market capitalization over $1 billion, operating with only $9.9 million in cash while burning through over $100 million annually is a razor-thin wire walk.
It is terrifying.
It leaves absolutely zero margin for error in execution.
The analysis points out that the stock actually fell from a peak of $8.45 down to where it is now. And clearly, Wall Street didn't beat the stock down because they suddenly decided the AI product was flawed or that agentic commerce wasn't the future.
No, the market beat it down out of sheer mechanical self-preservation. Specifically, they are pricing in a major liquidity event. This is the $138 million elephant in the room.
The need for cash.
Yes. There is a massive temporal gap between their current cash burn rate and the time it will actually take to collect and bank that $200 million plus in contracted ARR. To survive that gap, to keep the lights on the servers running and the engineers paid, they are highly likely to need a capital raise.
Right.
And when a public company needs cash fast with that kind of burn rate, they are staring down the barrel of a secondary offering.
Which dilutes the existing float. The pie gets cut into more slices. The market is highly efficient at sniffing out a cash crunch.
Very efficient.
Institutional investors look at that $9.9 million cash balance against the negative $138 million operating income, and they know the company has to issue new shares to bridge the gap. So they sell off or even short the stock, driving the price down to $2.73 because they are bracing for that inevitable dilution impact.
They are protecting their downside.
Exactly. They don't want to be holding the bag when the company increases the outstanding share count by 20 or 30% just to survive the year.
It is a textbook standoff between long-term enterprise potential and short-term liquidity risk. The technology is sound, the contracts are signed, but the runway is terrifyingly short.
Yeah.
To further contextualize this standoff, our source material brings in a competitive landscape comparison that I think is highly illustrative. They compare Rezolve AI to a structural software peer, Fastly, ticker symbol FSLY.
Let's dig into that because I found this comparison really helpful to frame the valuation ceiling. So Fastly currently trades at a price-to-sales ratio of about 4.9x, and they are operating with negative net margins as well.
Right.
But Fastly is only growing their revenue at a relatively mature rate of about 15 to 20% year over year. Contrast that with Rezolve, which is growing at over 400% on the GAAP side and projecting massive ARR jumps. It's converting completely different velocity.
Precisely, and this comparison helps address another metric that many listeners might intuitively screen for when evaluating a company's fundamentals, the PE, or price-to-earnings ratio.
Right, because if you look up Rezolve AI, you will see they have no PE ratio.
None. They are operating at a deep loss. And it is important to understand that in this specific sector, this is not necessarily a failure of the business model. It is an intentional strategy.
Because if they stop spending on growth to show a marginal profit, they would lose the land grab.
Exactly. In this early hypergrowth phase of the enterprise, SaaS lifecycle companies deliberately operate at a loss. Their primary objective is not to show a tidy net profit at the end of the quarter to satisfy dividend investors.
No.
Their objective is to aggressively capture a brand new multi-billion-dollar market before legacy competitors can establish a foothold. Therefore, traditional valuation metrics like PE are essentially useless here. The illusion of the PE ratio is that immediate profitability matters most. It doesn't.
So what does matter?
In this phase, the market measures the health of the company by weighing sales growth against cash burn.
And as we've established, the sales growth side of that equation is nothing short of incredible. 400% GAAP growth, destroying guidance to hit $200 million in ARR and projecting $500 million.
It is stellar.
But the cash flow quality, that meager $9.9 million in the bank against a massive burn rate, is the glaring weak link, holding the entire $1 billion valuation hostage.
It really is.
So how does this actually play out in the market right now? The analysis wraps up by looking at the technical chart set up for Rezolve AI to see how the psychology is manifesting in the price action.
And the technicals often provide a highly accurate psychological map of where the market stands on these fundamental issues. The fundamental data tells us why something is happening, but the technicals tell us how the market is positioning for the outcome.
The data notes that the stock is currently showing what traders call seller exhaustion. After bleeding out for months from that peak of $8.45, it hasn't just continued to freefall into the sub-dollar territory.
No, it hasn't.
It has built a very heavy, established base of support right in this $2.50 to $2.70 zone. Basically, the thesis is that everyone who is going to panic sell over the cash burn fears has already sold. Institutional dumping has paused. Trading volume has completely dried up,
which creates a fascinating, highly volatile dynamic moving forward. The report characterizes Rezolve AI as the ultimate high-risk, ultra-high-reward turnaround setup. It is quite literally a coiled spring.
A coiled spring, I like that.
The selling pressure has exhausted itself, but the buyers are waiting on the sidelines for clarity. And the direction this stock springs depends entirely on one single factor: how management handles the liquidity gap over the next 2 quarters.
It's a binary outcome. If the cash runs out before those massive enterprise checks from companies like H&M actually clear the bank and hit the balance sheet, they will be forced into a highly dilutive capital raise at these depressed price levels.
And if that happens, the stock gets crushed further.
Right. The $2 price tag might even look expensive in hindsight if the share count doubles.
But conversely, if the management team manages to secure non-dilutive bridge financing, perhaps a strategic debt facility or a convertible note that delays dilution, or a major partnership that infuses cash without issuing common shares, the narrative shifts instantly.
It flips completely.
Yes. Or if the upcoming Q1 2026 earnings report shows a massive tangible realization of that gap revenue, meaning the massive contracted ARR is finally converting into actual cash flow, then the fear of a secondary offering evaporates.
And if that fear evaporates, the market mechanism reverses. Wall Street is going to be staring at a company with 95% gross margins, 400% growth, and a forward price-to-sales ratio of just 2.1x.
They won't ignore that.
The algorithmic screeners will catch the gap realization the institutional shorts will be forced to cover, and that is the exact recipe for a stock to rapidly re-rate back toward that $10 price target. It is a coiled spring, just waiting for a fundamental catalyst to prove the liquidity trap was a mirage.
It really is.
So what does this all mean? We have journeyed through some incredibly dense financial territory today. At its core, the analysis paints a picture of a dramatic, high-stakes battle.
Very high stakes.
In one corner, you have breathtaking elite margin AI growth that is actively revolutionizing how global brands handle the massive scale of digital commerce. In the other corner, you have a dangerously ticking financial clock, a balance sheet running on fumes, and the looming specter of shareholder dilution.
This raises an important question for you, the listener, as you evaluate this kind of complex fundamental setup. When you look at a situation like Rezolve AI, what dictates your strategy? Are you the type of analytical thinker who is more swayed by the long-term trajectory of a $500 million annual recurring revenue pipeline and the impenetrable moat of 95% gross margins?
Or does the immediate undeniable reality of a $9.9 million cash balance and the threat of a secondary offering keep you entirely on the sidelines, regardless of how revolutionary the technological promise might be?
It is a tough call.
It's the classic risk-reward scale tipped to the absolute extremes. And as we wrap up this deep dive, I want to leave you with one final thought to mull over. Something that builds on the massive implications of this technology, completely outside of just the stock price and the balance sheets. If agentic commerce and large language models eventually make our shopping completely conversational and automated, where highly intelligent AI agents are doing all the heavy lifting, instantly querying global databases, curating our options, and anticipating our needs for these massive brands, will human impulse buying become a thing of the past? Because we aren't aimlessly scrolling through grids of products anymore, getting distracted by things we didn't intend to buy. Or will these AI engines, armed with perfect data on our preferences, just get infinitely better at figuring out exactly how to trigger that impulse?
That is something to think about.
Thank you so much for joining us on this deep dive. We love taking apart these complex reports, looking past the surface level noise and uncovering the real mechanics behind the numbers with you. Keep questioning the consensus, keep learning, and we will catch you on the next one.
Don't forget to like, share, and subscribe for more.